You're absolutely right. 2022 was no fun to be invested in almost anything. The way I look at things is markets equity and bonds are cheaper and better value than they were a year ago. That's not to say they won't get cheaper again.
So there could be further falls. But the important thing to remember as an investor is you do this for the long term. And actually, when you get periods where markets have fallen, that actually offers you quite an attractive entry point when you're thinking about investing for the long term. Well, a very warm welcome to our listeners and also our viewers on YouTube. Today, in our big interview, what I wanted to do, as we're sort of sitting at the beginning of 2023, is to gaze into the crystal ball a little bit and have a think about what to expect in stock markets in the year ahead. So we've got an expert, the managing director from the very well-respected Chelsea Financial Services, and we're going to have a chat about all sorts of things. We're going to chat about savings. We're going to have a look at which markets around the globe are quite attractive, which assets are quite attractive. We're going to have a look at whether you should bother buying funds with stock pickers or you should just go for those cheaper kind of index strategies. And then we're going to delve into some investment ideas. And we're going to have a look across the spectrum, really. So we're going to have a look at some ideas for investors who may be a bit more cautious about risk. And then we're going to have a look at some that are a bit more adventurous as well. So speaking to us today, I'd like to introduce Darius McDermott. Darius, welcome.
Morning, how are you?
Very good. Thank you, Darius. Very good. So, well, let's start having a little look back at 2022. It wasn't really a fun time for investors. Markets sort of descended in what we would call bear market territory. So that means this sort of prolonged decline. They've dropped more than 20%. What were the problems of 2022?
Well, you're absolutely right. 2022 was no fun to be invested in almost anything. In fact, the first quarter of 2021, something very unusual happened. Every single asset class fell at the same time. And when I say every asset class, I mean everything. That hadn't happened for 30 years, just to put it into context of quite how unusual that sort of equities fell, bonds fell, everything fell. Now, why was that? I think it was quite clear at the time why it was. And I think looking back, it's easy to apportion blame to inflation. And in 2021, the word was transitory, where people thought inflation might just be here for a short period of time, maybe to do with COVID and supply chain blockages forcing prices up. What was quite obvious by the end of 2021, even to the central banks, was actually that this inflation wasn't transitory and was much more persistent. And not only was it persistent, but it kept going up, only really potentially peaking, and I'm going to use the word potentially, in really maybe December of last year. When inflation is high and persistent, the tools that central banks use to quell that inflation is to put interest rates up. If interest rates go up, broadly, that is a tool to slow the economy, to try and get that inflation back into a much more manageable area. It hasn't worked yet, but when interest rates go up, and they went up a lot. It started going up into December 2021 in the UK and in early 2022 in the States. And then it basically went up almost every single month in incremental quarters. What happened in America is they got a bit more panicky, if you like, and actually started raising interest rates, not just by a quarter, but by a half and 3/4. So bigger jumps. And that inflation became more obvious that it wasn't going to be short-lived. When interest rates go up and go up that quickly, firstly, the obvious thing is it's bad for bonds, right? So government bonds where you lend to companies, corporate bonds, there's a fairly sort of mathematical relationship where rates go up, bond prices go down because those yields go up. So very bad year for bonds. And so it's not always that rates are going to go up, it's the expectation that rates are going to go up. And that's why we've seen a very, very difficult first quarter of 2022. The other thing then with equities, the other sort of major asset class, is equities had a very good run. In 2021 saw global equities up around 20%. Apart from the very volatile period when COVID became clear was that we were in a new world of working from home, being restricted, and all those sort of things. The stock market reacted very badly. but then bounced very sharply from sort of in 2020. And then 2021, it's just like, oh, COVID never happened. Stock markets kept on going. The other observation to make is, equities were quite heavily valued. They'd been on a very long-term outperformance and giving good returns. In 2022, when there looked like there was trouble ahead, equities broadly gave back a chunk of those valuations, particularly in America. Just before we came on, I had a sort of a quick look at the S&P over a 1 year. So we're not quite all of 2022, but plus a week. The S&P was down 16% over 1 year. The Nasdaq down nearly 30. Actually, the FTSE, the good old FTSE 100, and maybe we will talk about that later, is actually up 3.5. Whereas UK smaller companies and mid-sized companies were down, well, small cap index over a year was down 13%. If we'd had this conversation in October 2022, they were down nearly 20%. They've actually had a bit of a rally from that low. So yes, a bad year, 2022. For me, I mean, look, investing isn't easy. You have to remind yourself of why you're investing, why you're saving for your long-term or short or medium-term savings needs. And 2022 is a reminder that it doesn't always go up. And it was a fairly harsh reminder, but a reminder nevertheless that markets don't always go up. And we can't expect them to always go up.
So I suppose it was quite exceptional. We'd had a long period, more than a decade, where they'd performed very strongly, but also inflation had been very low. Interest rates had been very, very low. And suddenly 2022 came around and inflation suddenly appeared. Lots of people for a long time had sort of said that we were in this sort of post almost high inflationary world. And suddenly central banks really needed to get to grips with it. So did very harsh interest rates, and that just crushed what had been a very, very strong period for lots of investments for a very long time. So we've had this sort of almost exceptional kind of correction in markets. Then looking forward to 2023, is that it? Is the pain done now, or are we going to see a year that's a little bit brighter?
Like lots of things in markets and people like ourselves who have to try to make predictions, things can often seem too gloomy when you're in the depths of a bear market. And when things are going well, they can often seem not too good. The one thing which we didn't touch on in our previous what happened in 2022 is the dirty word of recession. We did talk about rates going up consistently, and there is something called the yield curve, and I will try to make a very brief and fairly simple explanation. When you lend to the US government, probably the most stable institution on the planet, if I lend to them for 10 years, I might expect to get more interest than if I lend to them for 2 years. And that would normally be deemed to be an upward steeping curve over time. So if I lend to you for 2 years, you pay me 3%. If I lend to you for 10 years, you pay me 5%. What actually is happening at the moment is if I lend to you for 2 years, I'm getting paid more than if that's, when I say you, I mean the US government, than if I lend to them for 10 years. Now that's called an inverted yield curve. And it's not normal. Okay. Why should I get paid more to lend to any entity for 2 years than for 10 years? I want more money for that extra duration risk. When you get this inverted yield curve, it doesn't happen often. But what it has done is happened before every recession since the 1960s, and is what people call a leading indicator. When this happens, and we know in our own country, cost of living crisis, rates are going up, inflation is high, people are less likely to spend. And in fact, in the UK, there was negative GDP in parts of last year. The full definition of a recession is 2 consecutive quarters of negative GDP. The signs are on for recession, which isn't particularly nice. Our economy slows, we're less likely to spend, and we feel the pinch. One might argue that most people in the UK certainly felt the pinch in 2022. And I wouldn't argue that was the case. But in recessions, another leading indicator of recession is difficult stock markets, which we've already touched on. Now, the question is has there been enough pain for this very well telegraphed recession? Maybe this recession never actually happens. It's been so well telegraphed. And normally recessions come quickly for reasons of financial crisis or exuberance, as in the technology bubble, or unforeseen things like COVID. This one is sort of everyone saying, we're going into recession in 22 and 23. Maybe we don't, who knows? But an inverted yield curve is a great, it's a historical sign of recession. Of course, we've got an energy crisis in Europe, which has had extra difficulty because of the Russia-Ukraine situation. That's not a US phenomenon because they have their own energy sources. So maybe the recession is worse in UK and Europe, which is, again, fairly well predicted now, not said specifically by me, but other economic commentators and forecasters in central banks and big companies like JP Morgan and Credit Suisse. And I'm not sure, I hate to be too negative at the start of the year, that maybe we have felt enough pain. As I said, the FTSE's actually up. Now, the FTSE had underperformed the US stock markets for that decade because it's an old index full of mining companies and banks and oil companies. Some of the things that actually did well in 2022 because of energy and the higher energy prices. So I would try to say, the way I look at things is markets for equity and bonds are cheaper and better value than they were a year ago. That's not to say they won't get cheaper again. But if we come back to reminding ourselves, why are we saving? Why are we investing? If I'm investing for something in the middle of 2022, maybe I don't want to take too much risk in 2023. I maybe don't want to take too much risk at the start of 2023. But if I'm saving for 2030, for retirement or beyond, actually these volatilities and pullback in markets are helpful because you get more money into the market at these times and you get better value. But I'm certainly not going to sit here and predict that everything's going to be rosy in the garden in 2023 because I don't know. And I think enough clouds to maybe suggest it might be another difficult year.
So, of course, yes, it's important for investors to remember that stock markets are forward-looking. They're a forward-looking reflection of what the business environment is going to be. And they're low at the moment because they're predicting the business environment is going to be quite difficult on account of a supposed recession that's coming around the corner. But it could be worse. So there could be further falls. But the important thing to remember as an investor is you do this for the long term. And actually, when you get periods where markets fallen, that actually offers you quite an attractive entry point when you're thinking about investing for the long term.
There's behavioral finance comes into this, Marcus, of course. Nobody likes looking at their pension statement and go, wow, my investments were down 20% last year. But actually, unless you're crystallizing or selling out of the market, it's almost irrelevant. It's not nice. Nobody likes seeing something that they own go down 10, 20 or whatever percent. But you only make that worse if you actually get your ISA statement and think, oh, I had 50,000 investment. Now I've only got 35,000. You only make that worse if you actually sell it rather than thinking, no, I was saving for this pot to support my pension or to buy a house or whatever it might be in 3, 5, 10 years time. It is hard to lose money on paper and then think of it as a positive to your long-term savings goal. But any money that you invest in, say, a global index now would buy you 15, 20% more units than you would have bought a year ago. So that's the way one has to think.
Actually, I mean, we're talking about investing. Savings rates have obviously gone up. That's one of the benefits, I suppose, of a higher interest rate environment. Is there much better value in saving at the moment, though, given where inflation is?
Well, I mean, you answered your own question by mentioning the inflation word. I mean, firstly, I would say is cash rates are better. Clearly, they are than a year ago. I wouldn't describe them as good yet. I think the banks and building societies and lenders are taking an opportunity to fill their boots. A bank or a lender works by, I lend you money at 5% and I pay somebody 3%. That's called an interest margin of, say, 2%, to keep in that simple example. If I'm a banker or lender and I want to take lots of deposits in, well, I don't pay you 3, I'd probably pay you 3.5 or 4 to be a market leader. But then my margin shrinks, but I get more money in. The more you in, the more margin you make. You can make more money that way. So I think the lenders are being a bit slow to pass on the full benefit to cash savers. But if rates do continue to go up, as the central banks have pretty much told us, then interest rates will go up and savings rates should actually improve in the first half of 2023. But if I'm getting a cash rate of, say, 3 or maybe 4 and inflation is 10, then I'm clearly still having a negative real return. So whilst cash is better than it was and may get better again, really it's the cash rate minus the rate of inflation is our real return. So yes, better than before, and may well still get better through the first half of 2023 with further rate rises. But I'm still losing money in a real environment because that inflation is so high. Hopefully, inflation does reverse, and we might see inflation falling from that particularly high level of around 10 to a lower number. I mean, I'm again not going to be nearly clever enough to try and guess at it is, but even if it were to fall to 6 or 7, it's still high when cash rates are 3 or 4.
Okay, let's have a little think about the world, I suppose. I mean, we've talked about there's quite a lot of negativity, I suppose, in markets at the moment. Are there any regions around the world or assets that you think are particularly attractive? If you were going to pick an area that maybe our listeners or viewers might have a little look at, are there any that sort of pique your interest?
So let's talk about a couple of different and maybe even slightly niche asset classes. Firstly, something which have just not been good value for a very long time is fixed income or bond investing. For a decent portion of the last decade, from about 2015 to really last year, if you lent money to the German government, another stable institution who will pay you back, they were actually going to pay you back less than you gave them. So it was called negative interest rates, and totally and utterly counterintuitive to anybody who has that trying to make money. But people got so scared that they were prepared to not lose money and let a negative interest rate. So if I lent to the German government, I'd give them £1 and they promised to give me back 99p in 3 years. Scratch my head at that. So fixed income, broadly, the government bond, which is deemed to be the safest part of bond investing, you lend to the American government, you lend to the British government, lend to European. Those interest rates have now risen with the interest rate environment. So I can now get a better return on investing in bonds. And in some cases, again, although there has been a bit of a rally in the fourth quarter of 2022, I can now get 6% on an investment grade bond with not a long duration. And the duration is the length of that loan. So if I get 6%, that's not unattractive. So I think bonds are finally more attractive, as the sort of that base part of the bond is the government bond yield, and that has risen. So if I then lend to a company via an investment grade corporate bond, or I have a fund manager do it for us, which we will come back to, I know it's an area you want to discuss, they can actually get another 2-3% over that government bond to give actually quite a potential handsome return of certainly north of 5-6% this year. So that's an area where there is now some value to investors. A couple of other areas which did very badly last year are China and UK small cap. Now, these are both much higher risk areas of investment. One of the things, and terminology that you may have heard before, but contrarian investing or investing in assets that everybody else hates. Well, everybody hates China. Everybody hated China last year, and it still got 20% cheaper again. So China is now at a multi-year valuation low. Now, there are some geopolitical issues with China. President Xi, having given himself a third term, which was undemocratic and all those sorts of things. Not that you naturally think of China as a democratic society, but also they've had continued lockdowns as they pursued a zero COVID policy. And that's left a very unhappy population. But even that, they've retrenched from that in December. Everybody hates China. And it's cheap, but it's cheap for a reason. So maybe that's an area that is attractive, but it won't be for everybody, and it's only for higher risk investors. The other area I touched on, which had a very bad time last year, was small cap investing, and just the contrarian or the sort of return to normal and forward-looking nature of small cap might mean that that is an attractive opportunity. But both of those are more volatile opportunities. And I did give bonds for, the more cautious investor, where you might make a return above that cash rate that we discussed a few moments ago to give us something, to at least try to attack that inflation figure so that we don't lose money on a real basis after inflation.
Let's get on to the sort of strategic approach, I suppose. We have a couple of options. We can buy funds, and we would always recommend using diversified portfolios, buying into funds rather than single stocks, because it manages your risk in a lot better way. And you can choose a fund that has an active stock picker, a fund manager that's paid to pick stocks out of a particular market that they think are very good and put them in the portfolio. Or you can go a much cheaper route, which is to buy just the market, an index, and there's no fund manager who sits and chooses that. It just buys all the same stocks in the same proportions. Is a market like this telling you that one particular way is a better way than another?
My investment career has almost been entirely researching active funds. So I have a natural bias to those. I always use the phrase, I'm not anti-passive, I'm just pro-active. So I'm pro for active management, but I'm not against passive. And passive does, as you rightly say, offer a cheaper entry point to indexes. So if we return to the start of 2021, and we were clever enough to know that the US index was going to be up 22%, well, you just buy the index. You do. And one of the things which, again, we've touched on in this podcast is inflation. Post the financial crisis in 2008, really, stock markets suffered very, very heavily, falling typically 50%. From that bottom of the stock market in 2009, everything went up for a decade. So again, if you just invested in index in that period, it wouldn't have been a bad thing to do, because the quantitative easing that happened following that financial crisis just meant all assets rose. We didn't get inflation per se, but we got asset price inflation. So equities went up, bonds went up, central banks just bought everything, and that pushed all the prices up.
So quantitative easing, this is the big money printing programs that central banks did in order to try and stimulate the economy from a monetary point of view.
Absolutely. So they bought assets, they bought bonds, and they didn't buy equities, although that was muted at one stage. And that pushed asset prices up. So when everything's just broadly going up, tends to be an environment maybe for more passive. I still believe I can get outperformance from active funds. And as we again touched on earlier, we were in a very low inflation rate and a very low interest rate environment. Then what happened in COVID is we got as much stimulus in 3 weeks, quantitative easing or announced stimulus, as we did in the previous 15 years or 13 years. And that has definitely fueled actual inflation this time round. So the question I ask myself, and I think investors should, is, are we in a slightly different environment for the next decade? And I broadly think we are. So when I talk to investors who had a very good time in that last decade, they tended to have been what we call growth investors. And by that, I mean people who are investing in companies that are growing, they're growing their market share, they're growing their earnings. Often doesn't necessarily lead to profitability in the short term, because they reinvest any profits they make to grow faster again. So that growth type investing was the winning strategy in the period from 2010 to 2020, the end of 2020. If you just did that actively, you would have outperformed the index by quite a long way. So you could have just bought a growth passive or growth ETF and you would have done very well. What we have seen since the end of 2020, when the vaccine announcement came, is we've seen a much more broad market condition where growth has not outperformed. And in fact, for various portions of the last 2 years, the value strategies have outperformed. Now, what do I mean by that? Well, I mean by those fund managers who look to buy stocks that are cheaper than they should be for various reasons. So I might be a bank, or we can work out what we think the bank is worth. Let's say it's worth a book value of 1, but it's trading on a half. So that would be a cheap stock. One of the areas that certainly fall into that in the UK stock market are things like mining, banking, financials. And broadly, they've had a better time. We talked about interest rates going up. That's good for banks. Banks make more money. But also because of the energy crisis, Shell, BP, well-known UK companies, did very well last year. So Are we in a slightly different environment for the years ahead? I think we are. I mean, I don't believe inflation is going back to zero. It might come from 10 to 3 or 4, who knows? But that in itself is quite a different environment for investing. That, I think, is a key thing. And a very long way of answering your question, maybe, but maybe a better environment for active management. Don't just pick last year's winners or last decade's winners, because maybe we're in a different environment, and that might lead to different outcomes. So for me, I think we're in a more broad market, but certainly I do expect volatility to stay high in 2023. That gives opportunity for both passive and active strategies. It's when you enter the market. But another great stock market saying is, it's time in the market rather than timing the market. And if we could all time the market, then we'd all do very, very well, because we'd buy high and sell, buy low and sell high. But that's just not so easy to do. So we try to save and invest consistently for long periods of time.
Okay, let's get on to some ideas. Now, of course, these are not recommendations. That's important to say as well. They're just some sort of ideas around different approaches for investors with different types of risks. So we're going to start with the cautious investor. What would you say there?
So I'm going to try and stick with some of the themes that I touched on. I think corporate bonds offer reasonable value here for moderate or cautious investors. A couple of funds that might be of interest: Lion Trust Sustainable Managed Income Fund. That's a corporate bond fund. Another seasoned investor who runs corporate bond funds is Royal London. They have a corporate bond fund managed by Jonathan Platt. He's been doing fixed income for well over 25 years. So he's very experienced and manages to give decent returns with a bit lower volatility. For the more adventurous investor, one might look at China. If you have the stomach to go that far up the risk curve, I would have maybe tipped China this time last year, and I would have definitely been wrong. One can always be early on investment things because they look cheap. So something like Fidelity China Special Sits, which is a Chinese investment trust run again by a very established team at Fidelity, who have a lot of people actually in China as well as in the UK to assist with their strategy. And not only is China cheap versus its own history, because we're buying an investment trust, you can actually get it at what's known as a discount. Now, I don't know if you want me to just explain what that might be, but the companies that they own in this trust are valued at what's called the net asset value. And that's based on the share prices. So it's a real number. But I can actually buy that asset at between an 8 and a 9% discount to that net asset value today. So not only could I be getting China, which I know to be cheap versus its long-term history, is I'm actually buying a trust where it's at a discount. So I'm getting a double whammy for my extra risk, for my adventurous.
Yeah, I'm just gonna just for our listeners, investment trusts are a niche in the industry, and they have this unique thing when you buy into them, in that the share prices can trade differently to the value of the underlying investment. So when they're not so in favor, people don't really want them, their shares can trade lower than the value of the investments within the portfolio. And conversely, when they're popular, actually, they can also rise to a premium. So it's one of these features. It does make them a bit more complex, but we, and I'm sure you do as well, love investment trusts. We think they're a great retail product.
Yeah, investment trusts have historically, over long periods of time, outperformed closed-ended or mutual funds or OICs or whatever. And often if the manager runs an open-ended strategy and an investment trust, which is a closed-ended strategy, the closed-ended strategy will outperform. But there's a but. That often comes with a bit more risk and a bit more volatility, because, as we've already touched on, the shares can trade above or below that net asset value, which is a discount or a premium. Very bad year for investment trusts last year in that falling market. And they can also borrow money, which is called gearing, to enhance those returns, which makes them more volatile. So we love investment trusts, but I do think investors need to be aware that they are a bit riskier and are subject to that premium discount swing. So you can actually take advantage of these things. When you see assets that trade at big discounts, you're actually getting a nice entry point. But a lot of investment trusts moved from net asset value or par, or even premiums, to big discounts last year in 2022. So again, not always easy for investors to hold, but long term they're great. They're great investment vehicles for retail investors as well as professional investors.
Okay, so that was China. Did you have another one as well?
The other area I sort of touched on was small cap investing. UK, UK small cap funds definitely had a more challenged time. Also, if you were a growth investor, and we did touch on that a little earlier, if you were a growth and a small cap investor, you had a torrid time. You had all the wind blowing in your face. So a fund which had a tougher time, but the managers still are very good. They stick to what they do. Is something like the Marlborough Microcap Fund. So this fund invests in very small companies, from sort of 50 to 100 million upwards. And that strategy as a strategy just had a tough time. Do I think the fund managers are still very good and good at what they do? Absolutely, I do. I think they're very good at what they do, but their strategy was very out of favor. So something like that, when markets sell off, smaller companies tend to underperform because there is a liquidity premium or a liquidity risk that goes with investing in smaller companies.
So this is how easy the shares are to trade when we say liquidity risk.
Yeah, and also the size of the company. So if you're Shell, a name we mentioned earlier, you're a big company, there's lots of your shares available for trading. You could go on and buy £5,000 or £10,000 worth of Shell shares like that, no problem. But if you're buying a smaller company, they are by definition less liquid. There are less shares and less of them on the market, and there are smaller companies. So there is that then liquidity risk that you get with buying small companies. And over long periods of time, small companies do tend to outperform larger companies. And that's another reason which, not only do I like active funds, but I do tend to have a personal bias to funds that invest in small and mid-sized companies because they do tend to outperform over the long period, but not again in 2022. The climate was very against them, hence they are cheaper. And we like to buy investments that are lowly valued and hope that they go up over the long term.
Okay, yeah. So I can see why that's a real adventurous pick there, because of course, yeah, the smaller the company, and that's what we mean by cap. Micro cap means very small. Then the more risk you are taking. But of course, as you said, because they got hammered so much, it means that they are looking very attractive, especially if you're thinking over the long term. Okay, then can we just round it off then for those who are seeking a bit of income? So I suppose maybe those are a bit nearer to retirement. Are there any picks that you've got there?
And I framed this pick from the position that maybe we're in a slightly different environment for investing. Interest rates are going to be higher than they were in the previous decade. And an investment strategy which had worked for many, many years but didn't in the last decade was UK income, or buying stocks that pay dividends. So here I'm going to be, again, maybe a little contrary and pick a UK income fund. A manager I met with late last year, Adrian Gosden, runs the GAM UK Equity Income Fund. He is invested in financials and miners and oil companies, out of favour part of market, but sorts of companies that can perform in this slightly higher interest rate environment. And unfortunately, I am old enough to have started my job in the 90s. And in the mid-90s, UK income funds were the mainstream of what people invested in. And for a decent part of the next decade in the noughties, buying stocks that paid a dividend, you don't have to take those dividends, you can compound them and buy more units in your fund, was actually a really popular way of investing. That fund is yielding nearly 5%. So again, that's a decent return ahead of cash, trying to give us a return towards that inflationary target. So something like a good old UK income fund, which were very out of favour in the last decade. Nobody even wanted UK equities post the Brexit vote. The whole world shunned UK equities. So I think even though it didn't underperform last year, in fact, it outperformed, that maybe that's a good strategy for income seekers, along with maybe some of that fixed income we talked about and some of those bonds, I think are giving a decent income return.
Okay. Well, on that note, Darius McDermott, thanks very much.
Thank you, Marcus.